Welcome. Today we are diving deep into the Canadian foreign tax credit. Now, if your business has any foreign operations, or if you're even considering expanding internationally, this is a topic you absolutely have to understand. It's one of the most intricate areas of tax law, and frankly, getting it wrong can be incredibly expensive. So, let's get into the details.
Here's our game plan. First, we'll start with the core principle, what the credit is supposed to do. Then, we'll get into the messy reality of why it's so complicated. After that, we'll look at Canada's legislative fix for this mess, explore a huge exception to that fix, and finally, we'll connect all the dots to see what this means for corporate strategy and, maybe most importantly, your cash flow.
So let's start at square one. What is the fundamental goal of the foreign tax credit? In our interconnected global economy, what problem is this piece of the tax code really trying to solve?
At its heart, it's all about preventing double taxation. Its main job is to ensure that your business isn't taxed on the very same dollar of profit twice, once by the foreign country where you earned that profit, and then a second time by Canada. This concept is really a cornerstone of international tax policy.
The intended outcome is beautifully simple, really. A Canadian company should end up paying a total amount of tax that's equal to the higher of the two countries' tax rates, not both of them added together. So, if a foreign country taxes you at 30% and Canada's rate is 25%, your total tax burden on that income should be 30%, not a crippling 55%. We call this tax neutrality.
Simple in theory, right? Well, that's the principle. But as soon as you step out of the textbook and into the real world, things get complicated very, very quickly. That straightforward goal of avoiding double tax runs into some major hurdles.
So why? If the idea is so clean, why are the mechanics of it so incredibly complex? Well, it all boils down to one fundamental disagreement. Different countries have completely different rulebooks for how they measure profit. And here is the absolute crux of the issue. The Canadian foreign tax credit is limited. It can only be claimed against foreign taxes that were paid on foreign income as defined by Canadian tax law. This single, seemingly small detail is where all the complexity begins.
Let's take a classic example, one that comes up all the time: depreciation. A foreign country might allow you to deduct the cost of your equipment very quickly. But Canada has its own set of rules, what we call the capital cost allowance, or CCA, which is just our term for tax depreciation. And those rules are often much less generous in the early years.
Now just look at this hypothetical. The revenue was the same, the other expenses are the same, but because the foreign jurisdiction allows a $100,000 depreciation claim, while Canada's CCA is only $50,000, you have two completely different taxable income figures from the exact same business operation. It's $100,000 for foreign tax purposes, but a full $150,000 for Canadian tax purposes. And the consequence of this mismatch? You can end up paying foreign tax on a slice of income that, from Canada's perspective, doesn't even exist yet. This creates a situation where genuine double taxation can occur, because the foreign taxes paid on that extra income might not be fully creditable in Canada in that year, which completely undermines the entire purpose of the credit.
So, you can see the problem. How does the Canadian tax system try to deal with this timing mess? Well, there's a legislative fix in place, but, and this is crucial, it only applies to a specific kind of income.
The good news is that the law recognizes this timing problem, at least when we're talking about income from active business operations. It provides a mechanism to make sure you don't permanently lose those valuable credits just because of a year-over-year calculation difference.
And the mechanism is pretty straightforward. You identify your unused foreign tax credits for the year. You can then carry them back 3 years to apply against past taxes, or carry them forward for up to 10 years to use against future taxes. That gives you a nice, flexible 14-year window to smooth out these timing differences and eventually get the relief you're entitled to.
But, and you knew there was a but coming, didn't you? This is a really, really big one. This convenient carryover solution does not apply to all types of foreign income. We need to draw a very sharp line in the sand here. We're talking about a whole different category of income, what the tax code calls non-business income, or property income. The easiest way to think about this is as passive income. Things like interest earned on a loan to a foreign subsidiary, royalties they might pay for a patent, or rent from a building they operate.
And when you put the two side by side, the difference in their treatment is, well, it's night and day. For active business income, you get that generous carryover period. For non-business income,
There are no carryover provisions. None. It's a use it or lose it system. If you can't use that tax credit in the year it arises, it's gone, at least as a credit.
Now, the tax code does throw you a bit of a lifeline. It's a sort of consolation prize. You're allowed to take those unused foreign taxes on non-business income and simply deduct them as an expense. But let's be clear, a deduction is not a credit. A deduction reduces your taxable income. A credit reduces your final tax bill dollar for dollar. They're not even in the same league in terms of value.
And this is exactly why it's so incredibly important to understand the precise nature of every dollar of income flowing from your foreign operations. Whether that dollar is classified as business or non-business income has massive direct financial consequences.
Okay, so let's pull back from the nitty-gritty tax rules for a moment. Let's talk about what all of this means for the big picture, for your business strategy, and for the actual cash in your bank account.
Look, managing your foreign tax credit is not just some year-end compliance chore you can hand off to the tax department. The technicalities we've just discussed have direct, tangible effects on your company's financial planning and its overall health.
Think about it. Those timing mismatches, especially with the business income carryovers, mean you might be paying significant Canadian tax today while simultaneously accumulating a bank of foreign tax credits that you can't actually use for years. This has a very real impact on your corporate cash flow, your working capital, and even how you calculate the true return on your international investments.
So here's the bottom line. This analysis has to be done before you make your move abroad. It's not enough to just decide between a branch or a subsidiary. You have to go deeper and forecast the nature of the transactions between the entities. Will they generate business income with those flexible credits, or will they generate non-business income with those highly restrictive rules? The answer can completely change your financial model.
And that really is the ultimate question for any leadership team considering foreign expansion. Is your structure truly designed for tax and cash flow efficiency, or are you inadvertently setting yourself up for a very unpleasant surprise a few years down the road? Proactive, informed planning is the only way to navigate this complexity and ensure your international venture is a genuine financial success.